Ryan Reynolds here from Mint Mobile. I don't know if you knew this, but anyone can get the same premium wireless for $15 a month plan that I've been enjoying. It's not just for celebrities. So do like I did and have one of your assistants switch you to Mint Mobile today. I'm told it's super easy to do at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Well, there's one thing you spend a lot of time dealing with, and there's one thing that you probably are most confused dealing with, and that one thing is money. We're going to try and make that one thing a little less frightening, clearing things up for you here on Talking Real Money. I'm Don. That's Tom over there. The phone number is 855-935-8255, 855-935-TALK. And we're going to make this a lot simpler for you. You keep making it hard, though. You've got to stop making it more difficult by thinking that there are smart people out there, that there is smart money, that there are folks out there who know a lot more about the markets than you do, and they're going to make all these brilliant decisions, and they're going to pick these big hot things, and you follow them around. I really believe that the term smart money is exactly the opposite. That the smart money is really the dumb money. And the dumb money, which is people who buy index funds and just rebalance occasionally and don't pay any attention, they're the dumb money. They're really the smart money. And I think that usually gets borne out eventually by stories in the media like this one.
Yeah, I mean, it's fascinating to me that 85% now of hedge funds and 42% of asset managers now have tracking software for tracking retail trading message boards. Let me say that again.
Like Reddit.
Yeah, the people that you referred to as the smart money, right? By the way, Billions is back on the air tomorrow night. The really smart
Speaking
money.
of which.
Yeah, the really smart money. They are following what people that trade like GameStop and AMC, et cetera, because they want to see, and some of the numbers they flash, JP Morgan estimates that individual investors accounted for more than a third of daily trading activity several times over the past 18 months. At one point, it was down to like 10% of the money that was being traded in Wall Street was traded by individuals. So I sincerely and severely doubt that it's a third. But let's assume that it is.
He's severe and sincere.
I know.
Nobody is as severe
right.
and sincere as Tom.
Let's just say that they're right. That a third of the money is hot money, right? It's chasing those really great investments. Do you think it makes sense for the people that do this day to day to say, well, then I'm going to do what they're doing because they seem to know what's next? Really?
Yeah. No, you see, here's what I think they're doing. I think this is that momentum thing that they want to try and catch the wave as it is building, as it is growing. You know, at the very beginning when people start talking about a stock, they want to kind of get in on that quick momentum play, thinking that they can time this right. If we can get in when they just start talking about it, then when it becomes a meme and it becomes really popular, we've already caught that wave and we're selling into that.
Like last year with the really hot thing with SPACs, right? Special purpose acquisition companies.
Yeah, there's nothing better than a SPAC.
Yeah, because right now about half of the SPACs are down about 40% from where they started. Let me say that again. About half of those investments are down. Do you buy anything with the idea that could go down 40%? You shouldn't. I mean, that's absolutely nuts. So, and a few of them are already going back to being privately held. Acorns, which is a service that we like, a rounding service, they did a SPAC deal. Now they're going to give the money back. They're going to go back and be private again because it has worked out so very, very poorly, among others. These are hot investments. The people that are running the smart money, you're truly right, Don. They know nothing more about the future than any of the rest of us. And they look very, very silly when they ushered people into SPACs and when they have tracking systems now that will tell them what meme stock will lead them to greater glory in the days ahead. That's outrageous. Truly, it is.
The smart money is the dumb money. And all of you who are doing this the right way, you're the smart money, so ignore them. They don't know anything. They're trying to manipulate you. They really are. I got a fake newspaper in the mail the other day. It looks like a newspaper, but it's fake. It's from some idiot in Texas who sells a newsletter on biotech stocks. And the whole thing is about buying into very risky companies that are manufacturing psychedelics for mental health treatments. This stuff is all dangerous. It's just gambling in a pretty wrapper, just like SPACs were. This is all dangerous.
And you listening, believe that somehow this will make you more money than just owning the market. That's the struggle. I mean, because people get sold into this and they truly think. There was somebody that told me once about us. Yeah, you could hire those guys. That's really slow. Or you could hire us. We're the limousine of investing. It's like, well, go ahead. Who's driving that limousine?
It's not true. It's just simple stuff.
Tom and Don are talking real money.
At some point, most investors need professional financial guidance. So get a little bit of free help or a lifetime of affordable 100% fiduciary guidance at Vestory.com, Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Yeah, we have exciting conversations during the break. We were talking about early 19th century history.
Never miss it.
Yeah, Tippecanoe. The reason was because we have a caller on the phone, and
so easy.
And it was just too easy for Tom to go Tippecanoe. And hi, Tyler. Welcome to Talking Real Money.
Hey guys, how's it going?
Good.
So right now I have two investment accounts. One is my Roth IRA with Vanguard, and the other is a taxable account with Vanguard that I just recently opened. And the reason I opened this taxable account is because I had a pretty good amount of money over the last several years just sitting in my savings account earning nothing. And so I decided to put the money to work. And as luck would have it, I opened up this taxable account at the beginning of the year. And I'm basically just bleeding principal right off the bat. And I'm trying to figure out what to do next because, to be quite honest, I was having a little bit of urge to sell, but I'm not sure that's the right decision.
Wait. Okay, so you opened this account at the beginning of the year?
This year?
Yeah, so
okay.
Yeah, so I never had a taxable account before, and I opened it up in late December, and I funded it the first week of January with quite a lot of money relative to my situation, and obviously it's gone very poorly.
Yeah, well, I was going to say, though, hasn't your Roth IRA bled the same amount of money?
Well, so with the Roth, obviously, I can only put in, small amounts, $6,000 a year.
Oh, so in it's as a percentage, your losses are very similar. You're just unhappy because you put it in right before the market went down.
Yeah, so like I said, I've had my Roth for years, and so it's gone up and down. But because I'm only putting in $6,000 a year, it's never gone down large.
Tyler, how old are you? How old are you, Tyler?
32.
Jeez. Tyler. Tyler, listen, hang on. This is really important for you to get. Markets don't go up all the time. They can't. They've got to go down sometime, but you're never going to know before, as you didn't this time, nor did we, that the first few weeks of the year would be bad for stocks. We had no idea. No one else did either. Those who guessed correctly merely guessed correctly.
And the money in this brokerage account is going to eventually be used for your retirement, buy a house. What is it there for?
Well, that's a good question. So my Roth, obviously, that's for retirement.
Yeah.
The money that I put into the taxable account was just money that I had that was just sitting in a savings account doing nothing. And so I don't have a particular goal for it. I just wanted it to work for me. But
you need a goal for it. That's one of the biggest mistakes people make is just having random money sitting around for which they have no ascribed purpose. Every bit of money you have should be earmarked for something, not a particular goal, not a specific goal, but an interim life events, future life events. So you have your emergency money. You have your money that you're not comfortable losing at all, that you might need for a home or something like that in the not too distant future. Then you have your, I'm not going to spend this until I'm really old money. And that money can be very aggressive.
And that would also help you around the fact that we've had a bad 3 weeks where we've seen, the S&P 500 down over 7%, et cetera, et cetera. I mean, in other words, you'd be like, doesn't matter. I'm not going to touch this money for another 30 years. So that's okay. In fact, I'm going to be saving more money and buying it at more shares at a lower price. Actually, going down for somebody 32 is a good thing.
What's this in, Tyler? What's it invested in at Vanguard, the taxable account?
It's a basket of ETFs. I have some small cap, mid cap, large cap, emerging markets, total
Good.
international.
Good.
And I think I have,
So my guess is your total loss for the year is right around 4%.
No, because I went pretty heavy in small cap, and so my small cap has got beat down, I think, close to 10%. I have the Vanguard VB, and it's just gotten really hammered, and I have a S&P 500 index fund, and so I think I'm down closer to
Are
7%.
you wait? You sounded to me like you were well diversified. So now we come down to how well are those assets spread? How much international do you have, for example?
International, I think, without having it in front of me,
Just
I would
guess.
say that it's probably around 30-35%.
Okay. Well, that's-
International small value is up 4% for the year. I'm just
Yeah.
looking at the total return here for the small U.S. small that you have, the VB, that is
VBR.
down about 7%. Okay.
Oh, you have just
again,
you have just VB?
VB said, yeah. So
Yes.
again, I mean, these aren't things you should be worrying about at 32 unless you need the money in the near term. Shouldn't matter.
Yeah, this is just part of the game.
Okay. Yep, that's kind of what I was thinking. But like I said, I've never got beat down like that before.
Well, good.
So-
It's good to get it out of the way. As a matter of fact, the best
Yeah.
time to get beaten down is when you're starting investing. The worst time to take a beat down in your portfolio is when you're starting to take money out and you have to rely on it. You're in the early part. This is the perfect time to get beaten. Are you continuing to earn enough money from which you can still continue to invest in these funds?
Yeah, absolutely.
Then if you have money sitting around right now that's ready to invest, put it in right now.
Okay, yeah. So I have, other than my emergency fund, I have just another checking account that I can use to add to it. But that's my fear, is just digging myself a deeper hole. But I guess
Okay,
you never
this
know
is where we
what's
have to talk about the reality of
Tyler?
the stock market.
Yeah.
I need you to listen really, really carefully because this is a fact. 3/4 of the time, the stock market has risen. Only 1/4 of the time has it gone down. You cannot have a straight line appreciation in stocks, because if they just went up and there was no risk of them ever going down, we would expect the average annual return for stocks to be right at or maybe slightly above the rate of inflation, or a net zero. These are the times that make stock investing worthwhile. It's the bad markets that make stock investing, at least have made stock investing, a way to make really good money over the past 100 years.
Okay. Well, that makes sense. And so you guys, I know you guys aren't in the business of predicting the future, but you guys believe that in the short term to medium term, I know the long term should be good, but even the short to medium term, you guys aren't worried about.
No, it could go right up tomorrow, just like it did in March of 2020. It could turn around and go right back up, or it could fall the rest of the year and on into next. And you know what? I have a big portfolio, all invest just like yours, and I'm not going to worry about it.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
All right, I have one more post-call message for not just for Tyler, but for Tippecanoe too.
And Tyler too. Okay. Yeah.
I have this message. This message is a message for Tippecanoe and Tyler too. Now, here's anybody. Do you know your history? Who was Tippecanoe?
Don knew this, by the way. I did not. I will be on 19th century, not really my area of specialty. But
all right, so here we go.
You got to say who it was.
I thought I would give people a minute.
Okay, we're waiting.
Yeah.
Don't say call in if you know. Because
don't
did
call.
That last week. That was
Benjamin
bad.
Harrison.
Yeah.
Who died very shortly after being elected, which made John Tyler president. Ta-da! Anyway, I have a message for all of you. And this is the thing we talk about all the time. And it's not just theory. If you are not prepared for the potential, if you're not prepared for the reality of an eventual loss that could be as big as 50% of your money, 50, not 50%, then you should not be in an aggressive portfolio, no matter what your age.
In a portfolio of 100% in stocks.
Right. And his is an aggressive stock portfolio.
He's 32. He shouldn't have I wouldn't have any bonds if I was 32. But
it's not age.
You're right. I agree. It's
so,
temperament.
Tyler, if you can't state to yourself, if you can't handle the heat, get out of the kitchen. Yeah. If you can't handle a 50% decline, you really have to redo your portfolio and get more money in bonds, which are going to make nothing, but they're not going to scare you as much.
Yeah, and you pointed out exactly. This is the reason that stocks have made more than government bonds, etc., because they're riskier. You have to accept the volatility of this. That's the trade-off. If they just went up every year, then they would not make, for lack of a better argument, 10% roughly a year. Wouldn't happen.
And to paraphrase a famous 18th century author.
We're moving to the 18th century now? Yeah.
Paraphrase. I'm going to paraphrase. Okay. These are the times that try investors' souls.
Oh, come on. We're down 5% year to date or something. 4.4. This is not the time.
This is what scares people, though.
Yeah.
It does.
And by the way, you said it wasn't just theory. It's not, because it almost happened as recently as 2020. I mean, we went down about 35% quick. Mm-hmm. And then 2008 it happened, 2000. So this is not just something, you're right, in a book. This has really happened to people that are stock market investors, correct?
And Tyler, just imagine how brilliant you would have felt if back in March of 2020 you put all this money in the stock market. Even with this decline, you would have gone, whoa, I was so smart.
100%.
It's not that you were dumb. It's just that this is what happens.
Yeah, and it doesn't, again, at 32, at 42, maybe even at 52, it does not matter one whit, period.
855-935-8255. That's talk there at the NTA, okay? That's the number. Give us a call. We'll try to answer your questions. And a lot of people also send them in to talkingrealmoney.com like this one. First, I just want to say I love your podcast. I've been a listener from way back, when you did one with Paul Merriman.
Actually, that is way back.
Yeah. Okay. In the past, my wife worked for Wells Fargo for 25 years.
Okay.
After she moved to another job, she left her 401k at Wells Fargo. Now she would like to move all her retirement into one single IRA that she has with Vanguard. Empower Retirement now handles her Wells Fargo 401k account. They insist on mailing her a check in the total amount to move the funds. Is this the 1980s? She's not comfortable with a check worth hundreds of thousands of dollars going through the mail. Is there any way around this? Thank you.
No, there is not. We deal with this every day because
I knew you. I knew exactly what you said. You go, no, they're just
I hate
idiots.
saying it, and I mean because now Boeing, by the way, has moved to Fidelity. I think in terms for the 401k this year, it's just as bad as it was last year. We're on hold with people that used to work at Boeing for 2-3 hours, and they mail them a check. Sorry, that's just the way it is.
I have a theory.
Okay,
I know. I
Hope it's a good
honestly
one.
have a very
Yeah.
sound theory as to why this happens. Because they liquidate the funds on X date,
Yeah.
then they
Oh,
deposit
this is
the funds into their own
Is
account.
it a thing called a float? Is that what
Of
you're
course they're
thinking?
using the float. As a matter of
Oh,
fact, what
yeah.
they're probably going to do is mail the account. He's on the East Coast. They'll mail the money from the West
yeah.
Coast account. So it takes a week to get to him. They get 7 days of float on his money. No, they can do it, and you have no say.
Tom and Don are talking real
Tom and I
money.
created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
Reality radio for a really great future. We're talking real money.
Hello. Welcome back to the show. I'm Don. That's Tom. Tom, fresh back from the Xcaret Resort.
Yeah. An unforgettable
Playa
experience.
del Carmen, Mexico.
Yeah.
Where the
Unforgettable.
gunfights are not staged. They use real bullets.
These are right there in the line for breakfast. So, yeah. Wow. That's all I can say. Wow.
Well, that's not what's got Tom mad, though. That's not what got Tom is frothing. He is frothing at the mouth, champing at the bit, just ready to explode. He is mad as hell, and he's not going to take it any longer.
Thank you. There's a good reference.
I am going to just turn the entire program from here over to Tom because he's going to rant for the rest of the hour.
No, I'm not.
Go for it. Rant.
And so call us. I will.
Oh, the phone number 855-935-TALK. There you go.
I will interrupt my rant. Well, you just heard one of my big complaints is
the check.
When you want to get, it's your money. When you want to get your money, they make it. I'm telling you, you may be right about the float.
I think I am.
They make it very difficult to get your money to you. Your money. Okay, that's one. Then I read, company. This is the headline: companies beef up 401k plans. You remember when we had the
what
COVID
does that
outbreak?
mean? By the way, beef it up.
I'm getting that. That's not a very great headline. I'll give you that. But remember in the spring of 2020, Don, those 2 years ago when COVID was raging? Well, I think it kind of still is, right? And it appears that like that 20% of companies, because it looked like the world was going to come to an end and we have to cut back our employee benefits to survive, 20% did. They cut back their match in their 401k. Now, remember, in I think with private business, it's still only about half of private employers have a employer-sponsored plan. It's still a relatively small number. Most people do, so only half. It's a small number. So people cut back their match. Well, guess what they're doing now? They're increasing their match. But I love the reason why. Here's a quote. In a tight labor market, we want to be in tune with the kinds of benefits we need in order to compete.
Well, wait a minute. Doesn't that make sense? Isn't it good that they're increasing their match? Wait a minute. Why are you mad about that?
Why did they decrease it? They decreased it because they thought they couldn't afford it, which turned out to be wrong. The reason that they're increasing it has nothing to do with let's see, who are the people? Oh, that's right, the employees, because maybe they want to be able to save enough for retirement, and there's no such thing as a pension anymore, right? Basically, in private enterprise.
Okay, hold. Let me hold my hand up. Pause you for a minute. Aren't you my capitalist friend?
In this case,
no,
my capitalist
aren't
friend.
you my capitalist friend? The one who says that businesses do what they need to do to make all the money they possibly can and screw the little guy?
Elizabeth Warren here at this moment. But
wait,
frankly,
you are you're looking more like Bernie Sanders.
Ouch. It's an outrage. And then the other one that it drives me. So they're going to be more generous.
We need to let him get this out of his system.
They
folks.
have to. And here's the other one that drives me nuts.
I know.
The vesting.
Like Vestory.
No,
wrong vesting.
Companies put in a match, and then if you want your money because you're leaving, oh no, you got to work there 5 years before you get the vested amount back. That's
Isn't
come on.
that capitalism too?
No, it's short-sighted capitalism is what it is. This is because, again, most people don't have a plan. The people that do have a plan should have a very good plan because there's no other way to save for retirement, basically. Yeah, you could put in the little bit of Roth money, et cetera. So, okay, that's it for my rant. All right,
this is
sorry.
a moment that's making me feel so much better about life. It's like Tom's finally coming around to caring about people.
Come on. I'll be back by the end of the show.
Not just the corporation, but the people who work there. He cares about you.
I'll be back by the end of the show. Don't worry. I'll turn it around. So.
He's not a fat cat capitalist anymore.
Well, look at me. I'm still a fat cat.
Oh, be still my heart. I'm verklempt.
Wait till you see the cards and letters I get for that one.
So verklempt. Oh, we're going to get it. We're going to get something. Because if we do anything that even has a hint
it's
of
not
politics,
political.
it
I
feels political.
know I said Elizabeth Warren, but okay.
Yeah. It gets us a 1-star review. Every time we joke around.
Yeah, that's right.
It's serious.
Yeah.
Every time we joke around about something political, we get a 1-star review. From
companies,
somebody.
You should have an employer sponsor plan. Companies, I think it's reasonable that you should do 50% match up to 6% of pay.
No.
I don't think, and there should be no period
be 5 to 1.
Okay,
10 to 1.
You shouldn't have to wait years to get the money that the company put. Come on, let's make it easier for people to retire, not harder.
I'm taunting him now.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Okay, we've tranquilized Tom. He's feeling a lot better now. Oh, look at how calm he is now.
Did I just say something bad about companies or something?
I
had a momentary lapse or something.
I don't know what's wrong with him.
Capitalism, whatever.
855-935-TALK is our phone number, 855-935-8255. It's free and it's easy. And, I mean, it's so easy. Dave did it. Hi, Dave. Welcome to Talking Real Money.
Hey, guys. I was curious if you had maybe like a broad sweeping endorsement or some sort of way you could address a REIT. I'm curious to getting into the whole real estate thing and probably want to avoid having to kick people out or, all the...
Oh, you don't want to be a landlord.
Right.
Yeah.
Right. So that's the idea. And I mean, I know people swear by storage units, if people don't pay their rent, you just throw all their stuff away or auction it or whatever. So anyway, does it just depend on the person's risk tolerance or maybe the time they want to spend in it, or what do you think?
Oh, no, we don't think it's any of that. We think if you want a job, a real full-time job, you go and you get real estate. If you want to just invest in real estate and make the money that real estate has made, primarily through income, it's an income generator more than anything else, then you buy a REIT. And we think the best way to buy a REIT is to buy a fund of REITs. So you own public storage and extra space storage, but you also own Duke Realty and home builders and things like that.
Okay, so are there specific ones, though, like a certain Vanguard one or anything?
I'm looking up the ticker right now.
Yeah, the Vanguard, if you're going to buy it, well, actually, the REIT ETF, they've got a REIT ETF, a U.S. REIT
fund, too.
Okay.
Yeah, they have a REIT ETF now that has really, 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 really low fees. It's 0.12 for real estate, and its symbol is VNQ.
Yeah, so there you're going to own hundreds of individual REITs. You mentioned self-storage. You're going to own some of that. You're going to own apartment complexes. You're going to own probably some shopping malls. You're going to own a wide variety and around. Is this a global REIT fund, Don? Or
This is just a U.S. REIT fund.
Yeah. So you're not going to own properties in other places, but you get pretty well diversified. And REITs can be kind of a counterbalance to stocks sometimes. Sometimes they can go up when stocks go down. I wouldn't promise that in the long haul, but they can be.
Now, the thing about REIT funds or any REIT is that you want to own the REIT in something that has some tax advantage to it because they are such income generators.
And they have to pay out 90% of that every year.
Right.
So you don't want to own it in an after-tax account because you're going to end up paying a lot in taxes, is what Don's saying. So it's preferable in a IRA, a Roth IRA, 401k. Qualified money makes way more sense than just having it sort of in a naked, if you will, brokerage account.
And then when you own a REIT like this, not only are you're not betting on one segment, like public or storage units could go bad on you, or like malls went bad for a period of time. The apartment market had a terrible run and then got hot. You don't have to worry about which segment of the real estate economy is doing well and which segment is not, because you own them all.
Perfect. Yeah, that sounds great.
Okay.
Thanks, guys. So I heard the one. Mostly the one.
Let's see. Who else?
VNQ, we like. That's Vanguard's. I was going to give you the stock, but there'd be no reason to own. If I would just go ahead and use the exchange traded fund. Yeah, there'd be no reason not to own that.
I wonder. I think Avantis has an international REIT fund.
Let's see here.
I'm looking it up here.
You know, I want to mention
Avantis
something.
Real Estate ETF. The symbol is AVRE. It is more. It's not much more expensive. It's only 0.17, which is really cheap. I'm just checking the portfolio holdings because I've never looked this up. Yes, it's 30% overseas. It's 30% international.
Yep, it is global.
And that is a really great expense ratio. That's another one to look at. I'd look at that Avantis. Its portfolio is very similar to Vanguard's.
The only reason I'd be a little hesitant there, according to the information that I have here, is this right? It only has $2 million in it. I mean, that is a very, 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 very small fund.
20 million.
Oh, okay. I thought 20. But even 20 million is pretty small.
That's a very small fund. But Avantis funds aren't very old.
And they do have the backing of American Century, who owns
this Avantis fund just started in late 2021.
Yeah. So again, we like REITs as a part of a portfolio. Mm-hmm. Again, we're still going to want you to own a lot of other things, but we think this is the better way to do it, as Don said, as opposed to, unless you want to be in business, buying and selling your own properties, managing them, et cetera, collecting the rents, fixing the toilets, whatever it is.
Such a pain. I've done it. Don't like it. We had a rental property. It was just a pain. And by the way, Dave, it's interesting, Tom, the Avantis, because it's international, has not declined as much in 2022 so far as has the Vanguard. The Vanguard's down 9.3 and the Avantis is down about 8.3 for the year.
Yeah. And remember last year, REITs had a great year. So you got to, again, any of these things, every security is going to go up and down. There isn't one security that goes up all the time. Nothing.
Not one.
No.
Not bonds. What?
We got another call here if we want to get to him.
It's Don. Yeah, we can get to Don.
If anybody named Don, we're pretty much
of course, we're going to Don. So. Hey, Don, welcome to Talking Real Money.
Yeah, hey, Don. Hey, just one real quick question. On your MDR, your minimum required distribution, I dollar cost average coming out, taking it every month. Because they say when you invest, dollar average in, so I averaged out. Is that a prudent way to go?
That's a great question. I don't think... what you're saying is you're taking out a certain amount. You're selling securities every month, so you're getting different prices. Remembering again that the market has an upward bias, so
that's why I don't think it's the best way to take it out.
The RMD, the best way to do it to get the most return generally is to wait until the end of the year. Take the RMD after the market has gone generally up in 3 of those 4 years. So that would be the most effective way in terms of prices. Most of this has to do with cash flow. I'd put it that way.
And the reality is you want to, because of that bias, because of the fact that market stocks, bonds, stocks particularly go up more than they go down. Bonds just kind of hang out. The fact that they go up more than they generally speaking, you want to leave it in as long as you can, tax deferred. you're giving up some of that tax deferral by dollar cost averaging out. And by the way, we don't think you should dollar cost average in either. We just know we think you should do it only because that's the way you earn money, so that you don't hoard the money and then put it in all at once. You should put it in as you earn it. So,
generally speaking, dollar cost averaging is going to cost you going in because the market has an upward bias. 75% of the months are up.
Going to cost you both ways.
Yeah. So
thanks for the call. We appreciate it. Remember, 24 hours a day, 7 days a week. You can call us. You can call us.
Not me. I'm not taking any more calls today. That's it.
And record your question, and then we will answer it. You will ask it. We will answer it on a future podcast.
You're really at the end of the week here?
My chest.
Trouble,
I think I'm actually catching COVID on the show.
That's
this
not
is a
funny.
live. I don't know. I'm like having a coughing fit. So call us at 855-935-TALK or visit us at talkingrealmoney.com, and you can ask questions there and learn stuff too. And we'll be right back.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
You know, when it comes to money, most of us need some help. Yeah, we see it every day. We talk about portfolio hodgepodge. We talk about retirement planning, kind of mistakes we want you to avoid. And maybe the thing we do the best, well, other than Don talking on the show.
We? Who's we?
I mean, I'm talking about Vestory by
our
Appella.
advisors.
I mean, we help people every day. We help people that never become our clients every day. Every single day. So if you want to talk to an advisor, if you want to talk to me, because a couple people did right after the podcast.
That again.
Okay. They said, sure, Tom will talk to me. Yeah, I will. I'll give you a free hour to make sure you're doing everything right. Again, for your retirement, for your portfolio, you can set up an appointment right online. It's very easy to do. You go to Vestory.com, Vestory.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?